Hi, and welcome to another episode of The Financial Advocate. This is Colin Meeks, and I'm here with Ryan Stark. We have got some short and sweet words of wisdom for you guys today. This is what we're going to talk about today. Pretty much everybody knows about this type of an account. Everybody we meet with, everybody we talk to has a bank account. Pretty standard stuff in today's day and age. And the topic that we want to talk about is FDIC insurance. And the reason we want to talk about it is because as interest rates have started to sort of come back up, and the interest rates you can receive on bank accounts and CDs and things like that have come up, people tend to paying a little bit more attention to how is that money protected. So we want to take a few minutes and talk about FDIC insurance. So basically the FDIC insurance, FDIC stands for Federal Deposit Insurance Corporation. It's a government agency independent of the United States government, and it's there to protect you in the event that the bank fails. They have various levels of protection. They've got a really good website, which we will attach to the show notes of this. We'll also attach a questions and answers thing, a sheet that they have that will answer a lot of the questions and answers that a lot of people have. But we just wanted to go through the basics of it today to give you an idea of, if I have money in the bank, how am I protected? So Ryan, take us through just the basics of it. How does the FDIC protect people? How much money are they protected up to? And how does it work?
So everyone is protected up to $250,000, and it actually goes by the titling of the account. So for example, me, I could have $250,000 for my individual account. If I had a joint with my wife, that's another $250,000. If I had a child, then I could have $250,000 with them, but only up to. But that's the important thing to mention about the joint. So even if I have two joint accounts, it's still $250,000 for both of them. So it can get a little confusing. So it's important to know exactly what you're doing when you're putting money in and making sure you understand the rules to make sure it's all protected. Because I feel what I see a lot is some people think it's per account title, so they'll put $250,000 accordingly. It's just a little bit of math, but that's at least the first basic place that I suggest everyone start.
Okay, and they have a really cool tool on their website. It's called EDI. It's the Electronic Deposit Insurance Estimator. So if you have the situation where you're having a lot of money in the bank, you can go there and it can walk you through how different accounts and how the different titling can show you how to protect more. And keep in mind, this is just per bank. So, if you go to Bank A on the corner of this street and then go across the street to the Bank B, you can open up a lot of different accounts and a lot of different titling and get protection well beyond that $250,000 range. Again, that's on their website. We'll attach that to the show notes. Let's talk a little bit, Ryan, about the different products insured that are at the bank. Is every product that comes out of a bank insured?
No.
Okay.
So an annuity, for example, is not going to be insured. A lot of people compare fixed rates in terms of CDs versus annuities. CDs, certificates of deposit, would be under that titling, under that umbrella of being protected, but an annuity would not.
Okay. And that's important to remember because we meet with a lot of folks that, just because you walk into the lobby of the bank and buy an annuity, or if you buy a mutual fund, or you buy some other type of investment that's not a FDIC insured investment, those particular funds are not insured. They're no safer than if you just were to go to a brokerage firm and buy them on your own. So that's really important to remember. And we deal a lot with folks that, again, like Ryan said, they shop rates, and we show them the current CD rates. We actually have a service called our Fixed Rate Watch, where every month we send out a sheet that shows current CD rates, and then we also compare it to other fixed rate products. The important thing to remember there is, we're comparing FDIC insured rates from a bank to things that aren't insured from other different, insurance companies and different other investment companies. So it's very important to remember that what's insured and what's not, and just because you buy it at a bank doesn't necessarily mean that you've got that FDIC stamp on things.
And that's a great point, because it's one of the things that can come across confusing, because you can buy a CD and an annuity in the same day. And if you're wondering why the rates might be different, CDs usually run a little bit higher. That's why. It's coming from.
CDs are lower.
Oh, I'm sorry, CD rates are lower. The annuity rates are a little bit higher for that reason, yes.
Yeah, and just disclosure-wise, fixed annuities are way different than CDs. They're long-term investment vehicles. They're designed for retirement purposes. Withdrawals made prior to 59 and a half are subject to a 10% IRS penalty and surrender charge. may apply, and all those guarantees that you read about in annuity ads are subject to the claims paying ability of the issuing company. Gains from tax-deferred investments are also taxed a little bit differently, and they're taxed as ordinary income upon withdrawal. So way different when we're talking, we're just happen to hit on annuities versus CDs. They're two different investment vehicles. The last thing I want to hit on is just a couple of resources that you can have, and we'll post them to the show notes. But the first thing will be a link to that EDI, the Electronic Deposit Insurance Estimator. That will show you how you can go through and get the maximum amount of insurance. And we'll also, there's the Your Insurance Deposits brochure, and that's a brochure that's printed out by the FDIC that will allow you, or that will show you some different questions that a lot of people have. So FDIC insured is a very, very good thing. It makes people feel good. You just need to understand how it works. Ryan, I think that was short and sweet. Anything else to add before we wrap up?
No, just adding on to the products versus planning. I think that's why we like to go through a planning process, because FDIC insured, covering a big chunk of money. We have a lot of older clients, a lot of people retired, so they want to keep their money safe. So we tell them you can use a couple different banks, a couple different accounts, and you can really start to protect a lot of money if that's the way you want to go. But that's why I think it's important to know the rules, and that's why I think you should check out the link that we'll post there,
right,
so that you can see for yourself how you're protected.
Yep, and also one last point to wrap up: we are not we're not anti-CD. A lot of advisors you meet with don't like you to put money into CDs because it's money they don't manage and it's money they don't make fees or commissions on. We go the complete other way with that. On our fixed rate watch, we actually tell you which banks have the highest CD rates that month and show you how to get them. We don't actually get any finder's fees or commissions, and we don't manage that money, but we're more than willing to show you if a CD fits into your plan. We're more than willing to show you where to get it and how to manage it. So keep that in mind. If you have any questions about FDIC insurance, anything else that we've talked about, please feel free to get in touch. And Ryan and I look forward to talking to you in our next episode of The Financial Advocate. Thanks.